And speaking of the banks, that's where we are now. Let's talk about the FDIC. It's reportedly mulling more support from big banks. That's according to a report from Bloomberg. And it comes after the country's 11 biggest banks agreed to create that $30 billion rescue package for First Republic Bank. So what would this basically require? It sounds like it would require those largest banks maybe coughing up more because the FDIC is facing about $23 billion in additional costs because of the recent bank failures. Again, that's according to that Bloomberg report. And normally when something like this happens, they do a fee assessment,
right,
or, a charge across all of the banks. Apparently what they're considering is weighting that charge more heavily towards the larger banks. They usually consider size, but it sounds like they're even going to more consider size when they try to figure out how much that should be.
Yeah, and that's the crux of it here. I mean, all of these banks typically pay into some type of insurance fund in the event of any strenuous kind of hardship that one bank or another faces. And because of that, perhaps insurance policy, as they would look at it, they're able to tap into that in order just to make sure that they've got enough cash or capital and able to weather through whatever or however long that period might be. And typically to avoid a collapse. However, given the run on the banks that had taken place, many of them unable to outright avoid it without either some type of partnership or injection of capital or deposits coming from other banks, and even some type of major and swift move or action from a combination, the consortium of the Federal Reserve, the FDIC, and the Treasury. And so now it seems like some of those larger banks, not only is this beneficial perhaps for them to be able to purchase more into, or at least invest more into as well, but I think at the end of the day, it's really just regulators trying to get a better kind of normalized view of exactly how much needs to be within this fund for hopefully the crisis doesn't come, but for the next crisis.
Well, and who should shoulder the responsibility at a time when maybe the smaller community lenders are a little bit more delicate? This is going to have an effect on the bank's balance sheets and the bank's bottom lines. Just for a little perspective here, this isn't the first time the FDIC has done these special assessments. There was one in 2009, for example, and JP Morgan said that it took a $675 million hit to its earnings in the second quarter of that year because of that assessment. So this is something, when this crisis started unfolding, one of the initial takes was this is going to have an effect on the profitability of these banks. And the more information we get seems to be shoring up that view that indeed this is going to have an effect on the profitability of the banks. The one other report that we should mention over the past couple of days is that the White House is talking about imposing tougher rules, more regulation on mid-sized banks. In other words, in effect, maybe reversing some of the rollbacks of Dodd-Frank from a few years ago that lightened regulations of mid-sized banks and perhaps paved the way for the collapse of SVB, for it to take on more risk, perhaps. So that's something that sounds like maybe the White House is mulling ways to not wait for Congress to act on that particular measure. So even though it feels like the crisis is abating, there's still a lot going on behind the scenes in order, to prevent it from worsening again, and prevent it from happening again at some point in the future.
Right.